Hi, and welcome to this morning's Global View video analysis. It's currently 5:45 a.m. U.S. Central Time on Friday, February 12th. We're coming to you a bit early because we want to get this posted up well ahead of the 7:30 Central Time U.S. Advanced Retail Sales, the next important data for the week, even if we have Michigan confidence after that this morning. So we have to ask, what does all this mean to the markets? And the bottom line is that the S&P is up $16 today, trading up at around the 1840 level, and that is follow through on yesterday's late recovery, and that is due to some rumblings from within OPEC. They're ready to do a bit of compromise on cutbacks. So crude oil being up, it was closed when that announcement was made yesterday, closed down in the low 26 area. It's up $1.50 to 27.5, and that's reinforcing the recovering commodity and energy instincts in the markets that are helping the equities. But as you can see, that's only partial help compared to where the market gapped down from out of Wednesday into Thursday from 1847 with a low of 1844. So it'll be interesting to see if it fills the rest of that gap or lapses back below the 1835 to 31 area. 31, of course, being the more classical historic low. That goes back to where the market hit into August of last year before it cleaned up. One of the key levels it hit before climbing back higher. And the other key lower levels are back at the 1804 low, which we will see on the daily chart, which it just about got to when that OPEC news hit. Looked like they were just about to maybe take it below 1800. Bigger lower supports are down in the 1777 to 75 area. Again at 1750, and ultimately the big low, trading low in Fibonacci area down at 1732 to 23. That pretty much does it for the lower support. Higher resistance is going to be back up at about on this channel down break, back up around 1755 nominally, but we know that plays right in to 1758 to 62, with the key higher resistance, that's 1858 to 62, of course, all of that. And that plays right into the higher resistance up around the 1875 to 77 area, with 1865 to 60 being the really key level we'll see once again on the monthly chart. And at least so far into this morning, being that much higher probably is not enough to take the hourly MACD back above its lower runaway band. So we'll have to keep an eye on that as well. And that pretty much does it for the short-term view of the S&P 500. And it is important to look at the monthly chart once again. And the reason for that, of course, is the long-term channel. Now, we went over a lot of the historic view in the weekend update on the equities and fixed income, separate from the foreign exchange, separate video. So we've covered all of the historic activity and the failure up here and the squeeze above the down break up in the 2015 area. So for now, we're just going to concentrate on the fact that this upward channel line is off the highest of the highs after the 2009 low. It's the upward channel from the big March of 2009 666 low, using this topping line and setting the parallel off the low at 1068 in October of 2011. So it's pretty big. The straight trend line is still here. That's part of the reason we look toward the 1750 area as support, along with other types of support like this Fibonacci area. However, to the degree the market remains below 1860 to 65 overall, it is likely to break these lower supports on the way to the ultimate test is the February of 2014 low and Fibonacci area 1726 to 1732 that we mentioned previous. And that pretty much does it for the S&P 500.